We are in a hybrid format again, so I would like to ask our colleagues, the journalists who are joining via WebEx, to turn on their cameras and their microphones when they ask questions. And now over to President Lagarde, please.
Thank you very much, Wolfgang, and good afternoon to all of you, or good morning for those who are overseas. The Vice President and I welcome you all to the press conference, and we would like to begin this press conference by congratulating Croatia on joining the euro area on January 1st, 2023. We also warmly welcome Boris Vucic, the governor of Hrvatska Narodna Banka, the National Central Bank of Croatia. We will now report on the outcome of today's meeting. The Governing Council will stay the course in raising interest rates significantly, at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Accordingly, the Governing Council today decided to raise the three key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand, and will also guard against the risk of a persistent upward shift in inflation expectations. In any event, our future policy rate decisions will continue to be data dependent and follow meeting by meetings approach. The Governing Council today also decided on the modalities for reducing the Eurosystem's holdings of securities under the asset purchase programme. As communicated in December, the asset purchase programme portfolio will decline by 15 billion euros per month on average from the beginning of March until the end of June 2023. And the subsequent pace of portfolio reduction will be determined over time. Partial reinvestments will be conducted broadly in line with current practices. In particular, the remaining reinvestment amounts will be allocated proportionally to the share of redemptions across each constituent programme of the APP and under the public sector purchase programme to the share of redemptions of each jurisdiction and across national and supranational issuers. For our corporate bond purchases, the remaining reinvestments will be tilted more strongly towards issuers with a better climate performance. Without prejudice to our price stability objective, this approach will support the gradual decarbonisation of the Eurosystem's corporate bond holdings in line with the goals of the Paris Agreement. The decisions taken today are set out in a press release available on our website. The detailed modalities for reducing the APP holdings are described in a separate press release which will be published at 3:45 local time. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity first. According to Eurostat's preliminary flash estimate, the euro area economy grew by 0.1% in the fourth quarter of 2022. While above the December Eurosystem staff projections, this outcome means that economic activity has slowed markedly since mid-22, and we expect it to stay weak in the near term. Subdued global activity and high geopolitical uncertainty, especially owing to Russia's unjustified war against Ukraine and its people, continue to act as headwinds to euro area growth. Together with high inflation and tighter financing conditions, these headwinds dampen spending and production, especially in the manufacturing sector. However, supply bottlenecks are gradually easing. The supply of gas has become more secure. Firms are still working off large order backlogs, and confidence is improving. Moreover, output in the services sector has been holding up, supported by continuing reopening effects and stronger demand for leisure activities. Rising wages and the recent decline in energy price inflation are also set to ease the loss of purchasing power that many people have experienced owing to high inflation. This, in turn, will support consumption. Overall, the economy has proved more resilient than expected and should recover over the coming quarters. The unemployment rate remained at its historical low of 6.6% in December 2022. However, the rate at which jobs are being created may slow, and unemployment could rise over the coming quarters. Government support measures to shield the economy from the impact of high energy prices should be temporary, targeted, and tailored to preserving incentives to consume less energy. In particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. Any such measures falling short of these principles are likely to drive up medium-term inflationary pressures, which would call for a stronger monetary policy response. Moreover, in line with the EU's economic governance framework, fiscal policies should be oriented towards making our economy more productive and gradually bringing down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can help reduce price pressures in the medium term. To that end, governments should swiftly implement their investment and structural reform plans under the Next Generation EU programme. The reform of the EU's economic governance framework should be concluded rapidly. Turning now to inflation. According to preliminary Eurostat's flash estimate, which has been calculated using Eurostat estimates for Germany, inflation was 8.5% in January. This would be 0.7 percentage point lower than the December figure, with the decline owing mainly to a renewed sharp drop in energy prices. Market-based indicators suggest that energy prices over the coming years will be significantly lower than expected at the time of our last meeting. Food price inflation edged higher to 14.1%, as the past surge in the cost of energy and of other inputs for food production is still feeding through to consumer prices. Price pressures remain strong, partly because high energy costs are spreading throughout the economy. Inflation, excluding energy and food, remained at 5.2% in January, with inflation for non-energy industrial goods rising to 6.9% and services inflation declining to 4.2%. Other indicators of underlying inflation are also still high. Government measures to compensate households for high energy prices will dampen inflation in 2023, but are expected to raise inflation once they expire. At the same time, the scale of some of these measures depends on the evolution of energy prices, and the expected contribution to inflation is particularly uncertain. Although supply bottlenecks are gradually easing, their delayed effects are still pushing up goods price inflation. And the same holds true for the lifting of pandemic-related restrictions. While weakening, the effect of pent-up demands is still driving up prices, especially in the services sector. Wages. Wages are growing faster, supported by robust labor markets, with some catch-up to high inflation becoming the main theme in wage negotiations. At the same time, recent data on wage dynamics have been in line with the December Eurosystem staff projections. Most measures of longer-term inflation expectations currently stand at around 2%, but these warrant continued monitoring. Turning to our risk assessment. The risks to the outlook for economic growth have become more balanced. Russia's unjustified war against Ukraine and its people continues to be a significant downside risk to the economy and could again push up the costs of energy and food. There could also be an additional drag on euro area growth if the world economy weakened more sharply than we expect. Moreover, the recovery would face obstacles if the pandemic were to re-intensify and cause renewed supply disruptions. However, the energy shock could fade away faster than anticipated, and euro area companies could adapt more quickly to the challenging international environment. This would support higher growth than currently expected. The risks to the inflation outlook have also become more balanced, especially in the near term. On the upside, existing pipeline pressures could still send retail prices higher in the near term. In addition, a stronger than expected economic rebound in China could give a fresh boost to commodity prices and foreign demand. Domestic factors such as a persistent rise in inflation expectations above our target or higher than anticipated wage rises could drive inflation higher also over the medium term. On the downside, the recent fall in energy prices, if it persists, may slow inflation more rapidly than expected. This downward pressure in the energy component could then also translate into weaker dynamics for underlying inflation. A further weakening of demand would also contribute to lower price pressures than currently anticipated, especially over the medium term. So let's now look at the financial and monetary conditions. As we tighten monetary policy, market interest rates are rising further, and credit to the private sector is becoming more expansive. Bank lending to firms has decelerated sharply over recent months. This partly stems from lower financing needs for inventories, but it also reflects weakening demand for loans to finance business investment in the context of a steep upward move in bank lending rates and a considerable tightening in credit standards, which is also visible in our most recent bank lending survey. Household borrowing has continued to weaken as well, reflecting rising lending rates, tighter credit standards, and a sharp fall in the demand for mortgages. As loan creation decelerates, money growth is also slowing rapidly, with a marked decline in its most liquid components, including overnight deposits, only partially compensated by a shift to term deposits. So summing up, the Governing Council will stay the course in raising interest rates significantly, at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target. Accordingly, we today decided to raise the 3 key ECB interest rates by 50 basis points, and we expect to raise them further. In view of the underlying inflation pressures, we intend to raise interest rates by another 50 basis points at our next monetary policy meeting in March, and we will then evaluate the subsequent path of our monetary policy. Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand and will also guard against the risk of persistent upward shift in inflation expectations. Moreover, from the beginning of March 2023, the APP portfolio will decline at a measured and predictable pace, as the Eurosystem will not reinvest all of the principal payments from maturing securities. Our future policy rate decisions will continue to be data-dependent and determined meeting by meetings. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target. And we are now ready to take your questions.
Thank you, President Lagarde. And the first question for Jana Rando of Bloomberg News. Jana, please.
Jana Rando with Bloomberg. Good afternoon.
Good afternoon.
I was wondering if you could give us a little bit or can you tell us a little bit about the flavor of the debate that preceded today's decision to raise interest rates by 50 basis points in March? I'm interested in knowing whether there were any calls to commit for longer, potentially flag a less aggressive stance, or say nothing at all, given that you also say that your decisions are data dependent. That would be my first question. And the second one, I'm interested when you say the subsequent policy path will be decided in March, are we just talking about the pace of rate increases, or could one potential conclusion also be that you have already reached the peak in interest rates at that time? Thank you.
Thank you very much. Those are really good questions to try to explain our decision. And I would just remind you that our decision is not the decision for March. We're taking a decision as of now, which is to raise all 3 interest rates by 50 basis points. I would characterize our good discussions with an enlarged Governing Council, given that we are now 26 around the table. I would characterize them as marked by the sign of continuity and consistency. And I know that I have repeated that in the course of the monetary policy statement, and I have said it before, but the expression, "we shall stay the course," or "the Governing Council will stay the course," is a good way to express that double principle of continuity and consistency. Continuity because we were very clear in December that in all reasonable scenarios, significant rate increases would be needed. Would be needed for what? To bring inflation back to the 2% medium-term objective that we have in a timely manner. And we also made it clear that this would require rates to rise to sufficiently restrictive levels, and that rate increases would happen at a steady state. So we are really making that decision in that continuity that I have tried to explain. Steady state, we increased rate by 50% in December. We increased rate by 50 basis points in early February, and we intend, which is a strong word, it's not an absolute irrevocable and conditional commitment, but it's a strong word. We intend to raise by 50 basis points, and that is what was meant in December by this steady state reference that you find yet again in the monetary policy statement. So this has been the continuity. Where we have consistency is consistency with the communication that we had back in December and with any communication that I have expressed ever since. And it's totally consistent with the view that we reached in a very, very large consensus today, that it should be 50 this time around, it is intended to be 50 in March. Now you will say, well, yes, but what about after March? Does that mean that you have reached the pinnacle or the peak? No, 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 no. We know that we have ground to cover. We know that we are not done. What we are saying is that as we will receive projections, we will need to assess what rates, what level, at what pace it will be needed in order to do the two things which in my view are embedded in my expression, stay the course. The first one is to raise significantly into too restrictive levels, and two, stay there for sufficiently long so that we are confident that at those rates we will actually deliver the 2% objective medium term that we have set for ourselves and which is delivering on our mandate. So those were the themes that we debated. I have to tell you that there was general agreement on the fact that the 50 basis point this time around and the 50 basis point in March were legitimate on the basis of, particularly in March, of the underlying inflation pressure that we know will continue. I think where there was discussion and not full agreement was on the way in which we communicate it. But on the overall monetary policy statement that reflects our discussions and our decision, there was a very, very large consensus. So I hope I have addressed your two important questions.
Thank you, President. The second question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon, Balazs Korani from Reuters. Thanks for taking my
afternoon.
questions. President Lagarde, back in Davos you said doubters should revise their positions if they don't believe that you're serious about inflation, but markets are again doubting you because the reaction to this decision was for financial conditions to actually ease a bit and expectations to come down. So what would you say to doubters today? And when you just told Jana that you have ground to cover, we are not done, are we correct to interpret that more rate hikes are coming beyond March at an unspecified rate? Is that what you meant? The second question is about the signals that you're sending. I mean, gas prices have come down to pre-war levels. Oil is down by a third since the summer. Your lending data is showing the biggest liquidity lending crunch since the debt crisis. Growth is at a standstill. There are lots of deflationary or at least disinflationary forces in the economy. So why would you set a guidance without having seen your projections? And why would you keep on providing a guidance when you said you would stop doing it? So I'm trying to understand the logic of how you communicate and why it's meeting by meeting one day and then you provide a guidance the next. Sometimes it's difficult to read what the ECB intends according to the people that we speak to.
Which is why I'm trying to, explain a bit better our reaction function. And I've tried to do that with Jana, if I may call you so, given that you do. But I will happily try to re-explain a bit what our intention is. First of all, we are data dependent, and we know that we're getting a projection exercise at our next March meeting. But we are also data dependent when we look at underlying inflation elements, and the underlying inflation pressure seems to be, whether you look at core, trimmed, super core, in all sorts of dimension, adding to which the measurement of the fiscal measures that have been put together, the wage negotiations and the wage direction that we are seeing. We have all scenarios available to decide that March actually warrants a 50 basis points increase. And this is what we are saying when we say we intend to, which is why the word is pretty strong. Now, in Davos, I did say that we shouldn't be doubted, and I think it was very much in relation to what we were going to do this time around and what we were going to do in the following meeting. And I hope that by being very specific about today's decision and pretty strong in terms of intention as to what we will do in March, those who observe carefully what we do will appreciate that we should not be doubted. And our determination to reach 2% medium-term inflation should not be doubted. And our determination to raise rates sufficiently significantly in order to move into restrictive territory should not be doubted. Nor should be doubted the fact that once we are in restrictive territory, we will want to stay there sufficiently so that we can be confident that those rates will give us the return to the 2% medium-term inflation objective that we have. Now, you will say, is that consistent with the meeting-by-meeting approach? You know, let's call a spade a spade. Meeting by meeting is going to be applied on the basis of data. But when we have data that is sufficiently strong, and when we are sufficiently far away from what we expect will be the appropriate rate to reach the 2%, it is completely legitimate to express an intention in a relatively forceful way. An intention is not, as I said, 100% commitment, but it's a pretty strong determination. And I can't, think of scenarios, unless they were quite extreme, where that would not happen.
Thank you, President. The next question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you very much for taking my question. I have one question on whether you're also discussing the negative side effects of your now policy raising rates substantially and very fast, especially on sectors like the real estate sector, and what it could also mean for the banks and balance sheet and consumption going forward. And then my second question goes on to QT, quantitative tightening. Perhaps you can explain a little bit more what you think you want to achieve with it, and whether there's also discussion to accelerate it and use it as an efficient policy tool. Thank you very much.
Yeah. You know, the occasion of this meeting was a very appropriate way to try to measure the effects and the consequences of our most recent monetary policy decisions. And it was so because we had the bank lending survey, which really helps appreciate how banks themselves see the rates that they will be offering, depending on whether they offer financing to corporates or to households or for consumption purposes. And it's also a good opportunity to have them assess for us in that survey whether they are going to tighten terms and conditions or not. Final point that we draw from those bank lending surveys that I'm sure you had a chance to look at as well is how they see the risk assessment proceed and develop as the situation evolves. And I would say that all that we are seeing, which is a tightening of the financing terms and conditions, higher rates across the various sectors of lending, is actually good transmission of our monetary policy. It's not the entire transmission, because by the time, you know, the investments is possibly reduced, financing is more expensive, impacts will channel through into the real economy. But we can tell that there is transmission of those rates already. And that was part of the propositions that we had, obviously. We are hearing the banks, and we have good dialogues with the banks on impacts that all our measures have. Our measures have impact on interest rates as well, in a different direction. So we are attentive to that, and of course we are attentive to financial stability, and this is something that, you know, comes into the decision-making process that we follow. But our objective is to reduce inflation, not just to reduce inflation, to drive it down to 2% in the medium term. So there will be consequences. There will be secondary effects as far as banks are concerned, inevitably. Now, you asked me also about the what I would call the balance sheet normalization. And I would preface that with the fact that in the current circumstances, our main tool is, of course, the interest rates. And the balance sheet normalization is helping us normalize the process, and it's not the main instrument. It's obviously part of the accessory instruments, if you will, that come to supplement the interest rate policy that we have. I think the approach that we have taken was also telegraphed back in December, when I said in this room that it would be predictable and measured. And I did mention the 15 billion monthly over a period of 4 months, from March to the end of June. That's what we are doing. So yet again, continuity, consistency in that partial reinvestment of the APP portfolio. And I think we're adding 2 principles that will matter, which is simplicity and neutrality, so that, you know, we don't do things in an awfully complicated manner, and we simply apply the proportionality principle to the portfolio across jurisdictions. Thank you.
Thank you, President. And the next question goes to Aude Kurselek of the French television channel BFM Business.
Good afternoon, Madame Lagarde, and thank you for taking my questions. First one, could you say it was a compromise between governors to nearly decide of 3 hikes of 50 BPs in a row from December to March? Does regularity matter to you? And does that mean it could continue at this pace in May? And a second question, in many sectors, companies and institutions as well, employees are asking for salary increases. What's your message about that? And at what point do these increases become dangerous with the risk of entrenching inflation? Thank you.
Well, thank you for your question. You know, any decision is the fruit of a compromise. And the beauty of the Governing Council is that all governors are passionate about the rational, the analysis, the hard econometric work that is behind what we do. And some take particular views, others other views, and they come to these meetings informed by their staff and by the work that they have done at home, within the Eurosystem, but in the national central banks. And the beauty of the exercise for me is to see how they can coalesce towards solutions that are recommended by our chief economist, Philip Lane, that I fully support, and that inevitably have elements of compromise about them. So compromise is the rule of the game, which does not weaken the fact that we're riveted to the mandate and that we know that we have to stay the course because we are not done. Your second question had to do with the wages, and it's a truly important aspect of inflation. It's a component that plays a critical role in the service sector in particular, which is far more labor intensive, and where we are looking and scrutinizing evolutions, both in terms of negotiated wages at collective level through unions and manufacturers associations, but also we are trying to really dissect as much as we can, and we have built, as you know, a special wage tracker that now includes 9 countries of the 20 members of the euro area. So critically important, and we know that there is an element of catch-up that is at play now, because obviously most recent numbers were high. Headline inflation numbers matter a lot. The fact that it went down to 8, well, at least preliminary until we have the German numbers, that it went down to 8.5% in the, in respect of those anticipation by unions or by workers is better in a sense, but it's a critical component that we will be looking at extremely carefully. And I think it's important. I know it's easier said than done, but it's important in those discussions and negotiations that there is a forward-looking approach to what inflation will be and how soon we will return it back to 2% in order to really appreciate the trend of wages that are discussed between the parties. Thank you.
Thank you. Turning to WebEx now, I'd like to give the floor to Delphine Strauss of the Financial Times. Delphine, over to you, please.
Thank you very much. Could I perhaps ask you to talk a little more about which elements of current inflation developments you're most concerned by, and how that differs from the economic environment at the moment in the US?
Thank you very much. Welcome on WebEx. What are we particularly attentive to in terms of inflation development? Now, obviously, we have to look at energy, because energy has been a key driver when inflation went up massively and went far too high. It is still far too high, by the way. So we have to look at energy costs because it might transmit, and at which pace we don't know, and we will be observing that very carefully, into underlying inflation elements. We are looking, as I just said to your colleague, very carefully at wages. Wages will be a significant component of inflation pressure in the months to come. We are looking at fiscal measures. And on the fiscal front, we have seen a lot of measures that were decided and part of the 2023 budget of euro area members. Some of them are going to try to recalibrate, others might not. And we had an excellent discussion with Pascal Donoghue, the president of the Eurogroup, yesterday. He came and participated in our discussion yesterday afternoon, and we had dinner together. So it was a very good opportunity to appreciate how the Eurogroup at finance ministers level is going to look at the fiscal measures, is going to look at recommending recalibration in order to make sure that fiscal support will be adjusted to the lower energy prices, which we do not see at the moment yet. So I would say that those are the key components. But what shall I say? On the international front, because I think that you raised a comparison with the US. I'm not going to compare with the US necessarily, but I need to bring into our consideration the international environment. The consequences of the Chinese authorities' decision in December to do away with zero COVID, to reopen the economy, come what may, are going to come with consequences. Consequences on demand, consequences on demand addressed to the rest of the world, consequences on exports, but also consequences on the price of commodities. If you start looking at the price of metals in particular, there has already been an anticipation of how commodities are going to rise as a result of the Chinese reopening. So there will be inflationary, disinflationary forces the exact detail of which I believe I will be able to say a bit more at our next March meeting, because we will be looking into that in the next few weeks. But that's also a country, the role of which we will be looking at very carefully. Thank you.
Thank you. And the next question goes to Marta Izan of the Spanish Negocios TV channel. Marta,
Thank you
please.
so much for having for taking my question, Mrs. Lagarde. I know you just said you're not going to compare with the US, but Powell said yesterday that the economy's disinflationary process has started. How far is Europe from being able to say the same? And another question, you said the decrease in inflation rate is primarily related to energy. So does this mean that the decrease is not due to the actions of the ECB? Do you expect the 2% in the medium term? And what is exactly the medium term?
Far from me to say that monetary policy is not potent and efficient. I think that what we are seeing in our bank lending survey, in the cost of financing in particular, is clearly an indication that there is transmission of our monetary policy and our interest rate hikes decision, clearly. So that is definitely working. But it's also true that a large portion of that too high inflation was attributable to the supply shock provoked by very high energy prices, and one that we did not really capture so well, which was gas prices and the impact it had on electricity cost. So we have to be attentive to those energy components, and we have to be attentive to the pace of transmission and the pass-through of those costs into other inflation component. But I would certainly not say that the disinflationary process at large and without qualification is already at play. When I look at core inflation, which is, by far not the only component that we look at many more of those. But when I look at core inflation, we were at 5 in November, moved up to 5.2 in December, stayed at 5.2. And this is the highest in all time that core inflation has been in our part of the world. So I get it. Headline inflation has gone down, and more so than we had expected, and that many had expected. But underlying inflation pressure is there, alive and kicking, which is why we are committing, as we are intending, as we intend in this monetary policy statement, and this is why I say that we have more ground to cover and we are not done.
Thank you, Madame Lagarde. And the next question goes to Jan Marlin of Handelsblatt. Jan, please.
Hello, Madame Lagarde. Thank you for the opportunity. In your statement, you described the risks to the inflation outlook as balanced.
No, I say more balanced.
More balanced compared to December. Could you say something about how important that is for the future rate path? And my second question also relates to that. Was that controversial within the council? Were there different views about that? Thank you.
Well, thank you very much for your question. I think the whole paragraph that you have in the monetary policy statement on risk assessment and I'm not going to offend you by reading it to you because I know that you have it, but it really focuses on in which way is this risk assessment more balanced, not balanced. We don't think that there is symmetry of risk, but it is more balanced than it was back in December, for sure. And it lists the various points that are upside risk, downside risk on both account on activity and inflation. Because my governors around the table of the Governing Council are genuinely interested in analyzing, understanding, and coming to as well-based conclusion as is possible, there was not a lot of discussion on that particular paragraph. It was a rather consensual assessment of the more balanced risk at this point in time. We will obviously reevaluate and assess again at the March meeting. Thank you.
Thank you. Returning back to WebEx, I would like to give the floor to Fabrizio Goria of La Stampa in Italy. Fabrizio, please.
There you go. Hello, thank you, President Lagarde, for taking my questions. There are two questions. The one is about the BLS survey and is about the credit crunch risks in the medium term. Do you see that? And the second one is about the TPI, the Transmission Protection Instrument that you mentioned in the statement. In this case, do you see any risks of market turmoil in the bond market? Thank you.
Thank you very much for your two questions. On the bank lending survey, as I said to one of your colleagues, we draw a lot of conclusions, learning, understanding of how our monetary policy, and particularly the interest rate policy that we have developed ever since July, is actually transmitted via the banks to corporates and to households and to consumption loans as well. And we believe that this impact is, in a way, efficient and necessary given what we are trying to do in order to reduce inflation and bring it back to 2%. The transmission protection instrument that was put in place, just to refresh our memory, because that goes back to June, was intended, sorry, July, wasn't it? Anyway, it was about 6 months ago, was intended to protect the transmission throughout the entire euro area. And it is available, it is there, it will be used if necessary. It is not the first line of defense. As you know, we have flexible reinvestment under the PEP as the first line of defense. If we were to see that transmission being impaired for non-legitimate reasons, but it is there and it is available. We don't see a need to use it at the moment, but should it be needed, we will indeed use it. Thank you.
Thank you. And the next question goes to Takari Minami of Nikkei. Takari, please.
Good afternoon. Thank you for taking my questions.
Good afternoon.
And the investors and the financial markets expect that the ECB will finish raising interest rate in coming April, for example, by the meetings in May. So, as you mentioned, I know well, so it depends on the coming data, but do you think such expectations are correct or wrong? Thank you.
You know, I'll go back to what we intend to do, or what we actually shall do, not intend to do. We shall return inflation to 2% in the medium term, in a timely manner. And we know that to do that, we need to move into restrictive territories, to restrictive levels. And we know that rates are the best tool in order to do so. So we will use interest rate hikes in order to get to those levels. And as I said, we are certainly not there now, nor will we be in March, given that we will rely on inflation, underlying inflation indicators and pressure that we see very, very clearly nowadays. What will happen next, as I said earlier on, is going to be a factor of how much more ground we need to cover, and there will be ground to cover most likely, but it will be data dependent. We will look at all components, and it will depend on the interest rates where we are then and where we believe we need to be in order to deliver on our commitment. But that will not be enough. We will have to stay there. So it's moving into restrictive territory because we know that's needed, given the elements that we have. But it's staying there so that we are confident that we don't touch the 2% for a few weeks, a few months, but that we have confidence that we will stay at target. So I hope that that satisfies your question. I'm tempted to ask you a question because we've been debating as to when the governor of the Central Bank of Japan, my good friend Mr. Kuroda, will have to step down, and there was big discussion internally in the House as to when it was, but you will tell me later.
Thank you. And the next question goes to Santiago Pinol of Market News International. Santiago, please.
Hi, good afternoon.
Good afternoon.
My question is following my colleagues too. It's on December you said that the ECB was going to raise rates 50 in February, possibly 50 in March, and possibly maybe in May. I was asking you, like, how is seen now May, because I don't know if it's less possibly than it was in December. And also on bonds, I would like to ask you, like, ESG bonds are constantly linked with greenwashing. How will the ECB manage the increased reputational risk implied by tilting bond purchases toward issuers with a better climate performance? Thank you.
Well, thank you very much for your questions. I think in December we mentioned significant, we mentioned steady rate, steady pace. In a steady manner, I think that's what we had used. And I said later on that our determination should not be doubted. It was 15 December, 15 February, we're doing it. And we intend, which is strong, as I said earlier on, to do 50 basis points based on the underlying inflation pressure that we see, anticipate, and are not going to go away. I'm not suggesting that it will be steady pace for an ongoing basis. What we're saying here in this monetary policy statement is that we will assess the situation, evaluate our monetary policy path on the basis of our projection. It might be 50, it might be 25, it might be whatever is needed, whatever rate is needed. I should say whatever rates are needed. We have 3, and then at whichever pace, in order to deliver on our 2% inflation target in the medium term that we want to reach in a timely manner. And we are far away from that. Inflation is still far too high today, in particular when we look at underlying inflation components. So, did you have another question? Yes. Oh, yes, of course, yes. Are we at risk of greenwashing? You know, as determined as I've always been, and you know me, it's been more than 3 years now. So as determined as I am to deliver on our strategy review and the action plan that we have all agreed around the table of the Governing Council, to deliver in alignment with the Paris Agreement, equally we have to manage risk. And managing risk to me is having as clear, as distinguished, as transparent information and disclosure as possible, a good understanding of the transition plan by the corporates that we eventually reinvest into, and a good understanding of the footprint that they have. And it will be on the basis of that analysis, our own, and also reliable analysis that will be provided by experts, that we will orientate our portfolio with a stronger tilting than we had so far. But we will be very attentive because it's just, we should not be accomplice to greenwashing, and it's a risk management principle that we have to comply with.
Thank you. And the last question is for Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. I'm here. A couple of questions. I'd like to come back to the fiscal message, the message you want to send to government. you said they should recalibrate. Is it really the right time to pull the plug when food inflation is at 14% and energy prices are indeed going down but are still hurting a lot of households? And the second question, if I may, is do you believe your course of action is basically in line with a soft landing? Because growth is basically zero already. Inflation is going down, and the hikes that you've put through will take months to really go through the economy. So is there a danger to go too far, basically, or does it look like a soft landing to you?
Great questions. On your first one concerning fiscal, I just want for everybody's good understanding, because it's a sentence that we discussed quite extensively this morning. It's in the section on economic activity. So it reads, and that's in relation to government support, that we say will shield the economy from the impact of high energy prices, you're right. But then we say, in particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. So it's not it's not asking governments to stop now, but they clearly have to align their fiscal support with the energy price impact at retail level when it comes to supporting consumers, and at corporate level whenever it hits corporate. But many of these measures were decided in the course of the budgetary cycle, which it starts in the summer, it's active work in September, voted in December, and the measures apply throughout the whole of 23. And if that recalibration does not happen, for those measures that were not subject to variation of energy prices and therefore would automatically adjust, then the other measures should be thought through and reconsidered, not with a view to remove the shields, but simply taking note of the fact that the shield is not as badly needed as it was. So I think that's our advocacy to governments, and it's something that we discussed with the president of the Eurogroup yesterday in particular. So on the monetary policy decisions that we are making, as I said, we are riveted to staying the course, to move into restrictive territory sufficiently, and for long enough so that we're confident that we return inflation to 2%. There are some good news because, growth, which was expected to be negative in the fourth quarter of 22, is eventually slightly positive. Now, we Europeans always beat our chest, and we're going to say that, well, if you take this out and this out and this out, it's not so positive. I think we should celebrate that we are not in negative territory on the growth front. Headline is going down, which I think is going to be important, in particular for the wage negotiations that will be coming up. But we still have underlying inflation factors that are strong, solid, and are not budging. So we need to do our job. We need to deliver on our mission.
Thank you. That finishes the press conference. Next meeting and press conference is 16 March. Until then, all the best to all of you. Thank you very much.
제가 유럽중앙은행 해석하고 있을 동안에 이미 끝난 것 같습니다. 영국 베일리 총재가 질의응답을 다 받았고 1시간도 안 돼서 다 끝난 것 같아요. 자, 그래서 그거를 요약한 기사를 좀 가져왔는데, 자, 기사 자체가 유럽중앙은행과 영국중앙은행이 둘 다 자신들의 추가 금리 인상에 관해서 이야기를 했는데 약간 방향성이 달랐다라고 이야기를 하고 있습니다. 먼저 유럽을 이야기하자면 저희가 다 해석을 했지만, 자, 여기 보시면 인플레이션 수치가 유럽은 12월에 9.2%였는데 8.5%로 떨어졌기 때문에 당연히 긍정적으로 바라보고 유럽도 금리를 좀 인하하거나 금리 인상을 중단할 수도 있겠다라고 생각을 했었는데, 오늘 발표는 뭐였냐? 그러지 않겠다. 이번에도 0.5 올렸고 다음 달에도 또 0.5 올릴 거라고 아예 못을 박았지 않습니까? 자, 그렇기 때문에 투자자들은 좋지 않게 받아들인 것 같아요. 그 근거로 지금 음식이랑 에너지 코스트가, 그러니까 음식 가격이 계속 올랐고 그걸 아직 잡을 만한 마땅한 대응안이 없고, 자, 러시아 전쟁으로 인한 에너지 코스트 역시 뭐 추락할 것이라고, 가격이 떨어질 것이라고 예상은 하지만 실제로 그게 일어나지 않았기 때문에 자신들은 계속해서 이러한 기조를 이어나갈 것이라고 강력하게 이야기를 했다. 잉글랜드 같은 경우, 영국 같은 경우는 조금 더 희망적인 메시지를 줬다고 합니다. 여기 보시면 그냥 딱 한마디면 끝났네요. 금리 인상이 거의 막바지에 달했다. 그래서 금방 멈출 것이라고 이야기를 했다고 합니다.